Hello everyone and welcome back to the channel where we break down the interesting and yet intriguing world of stock market into easily digestible nuggets. So today we're going to talk about the realm of exchange traded funds, better known as ETFs, and explore one that's really making waves among retail traders. If the vast expanse of individual stocks has ever felt very overwhelming, ETF can be your solution. And for retail investors navigating the stock market, identifying promising stocks might be a huge challenge. Limited information and technological barriers often obscure those potential gems. But don't worry because ETFs are here to simplify the procedure. Think of them as treasure chests housing a variety of stocks with robust growth potentials. Instead of looking for the needle in a haystack, you're now having a haystack, needles and all, at your disposal. So today, let's delve into one such ETF that's been catching the eyes of many retail traders. Different ETFs cater to different purposes, aligning with various sectors and investment goals. In a prior video, we delved into SCHD, the Schwab US Dividend ETF, which is a very popular choice amongst investors. And today we're going to talk about the Vanguard High Dividend Yield ETF trading under the ticker symbol VYM or VYM on the Nasdaq. So VYM acts like a financial superhero to many retail traders because it has been crafted to provide exposure to companies showcasing both quality and growth potentials. This ETF holds a basket of carefully selected stocks. It allows investors to tap into the success stories of multiple companies without the need for exhaustive research for each of them. Not to mention, it only charges around 0.06% of the expenses, which is a remarkable 15 times lower than most funds of a similar nature and 5 times lower than ETFs like SCHD. What further sets VYM apart is its focus on companies boasting strong fundamentals and a consistent track record on dividend growth. This blend of quality and dividend growth can be a winning formula for long-term investors seeking stability and income. So in today's video, we're going to explore VYM, compare it to other options on the market, and discuss what is the best trading approach given the current circumstances. Before we continue with today's video, if you like what you see, please consider to like, comment, and to subscribe to my channel. And also check out the video analysis organized in playlist on my channel page if that suits your needs. With that being said, let's dive into today's topic. In recent times, VYM has been hovering around the $109.98 range, indicating a marginal 2% increase over the last 5 days, a 0.42% uptick in the past month, and 2.4% increase over the preceding 6 months, reaching a low of about $96.71 on October 27th. Now, it's noteworthy that VYM has been following a lateral trajectory over the past 12 months, experiencing an approximately 1.3% growth during this period. Now, currently it is positioned close to the upper threshold of the ongoing channel. Functioning as a diversified dividend fund, VYM holds a substantial portfolio with positions known for their stability and brand strength in distributing dividends in its investors. The yield of VYM is similar to SCHD at around 3.7%. In operation since 2006, it offers options for both hedging and exposure increase purposes. The ETF predominantly focuses on large caps, constituting 97% of its holdings, aligning with the nature and purpose of VYM. Now, a key difference with SCHD lies in the sectors where their exposures are concentrated. VYM appears to have a much more pronounced presence in the tech sector compared to SCHD, which leans towards traditional sectors. While VYM may seem to exhibit more significant growth potentials initially, it's crucial to also note that its top 2 investments, Microsoft and Apple, are highly mature and leveraged players in a tech field that already commands high valuations. Consequently, we should always be prepared for potential price adjustments, especially if the price factors in a recession. So, regarding the dividends, Vym has encountered variations throughout the years, which is consistent with the market performance. There are also trends, but these are less finely tuned compared to the counterparts like SCHD. But nevertheless, it upholds a consistent trajectory of increasing dividends over time, presenting a compelling rationale for contemplating a long-term retention of Vym. With that being said, here are the technicals. The trading volume of Vanguard High Dividend Yield ETF has recently been around 1 million shares compared to the average volume of 1.4 million shares. Over the previous 52 weeks period, the price fluctuated between $98.40 and $112.70. The volume of shares traded tells us how many shares are being bought and sold at any given point in time, and if there's enough liquidity to support a trading strategy. For thin floats, it would be very easy to push the stock price around, but hard to get out in a trading strategy. The assets under management of Vym is currently at around $50.4 billion, which is very significant. As we compare the current price to the historical price fluctuations, the stock is around 0.4% higher than the 1-month low, 12% higher than the 3-month low, and 12% higher than the 52 weeks low. On the options market, which may give us a hint on the market sentiment about where the stock price likely go next, the implied volatility is 11% compared to a historical volatility of 11% as well. The put-call volume ratio is currently at around 24%. It is normal for many stocks to have a higher put option volume than what they deserve, as many institutional investors may hedge their long positions by buying put options. The most recent volume of options traded is around 472 contracts a day, compared to the 30-day average of 247 contracts. In terms of open interest, the most recent volume of open interest is around 19,000 contracts, compared to the 30-day average of 19,000 as well. Regarding the shareholder structure, institutional shareholders own 40% of the outstanding shares, the biggest shareholders including Bank of America, Morgan Stanley, and LPL Financial LLC. It is always good to see some institutional presence in holding a stock long term, because it gives us some more confidence and reliability in the medium to long term outlook. It means that the market believes that it will be able to deliver value in the long term, which is a very important factor to consider for investors. Now, I personally consider the minimum threshold to be around 25 to 30% for institutional ownership. There may be many other exceptions, but that's the rule. The current short interest is around 304,000 contracts on a total float, which is very low, and I don't think that there is much of an argument for any sort. Of course, analyzing securities from a fundamental perspective is always helpful, but it should be complemented with extra external forces at play. Investing in the stock market can sometimes feel like riding a roller coaster with its many ups and downs. This roller coaster may seem arbitrary if we compare the company's operational reports and its share price action. It is profoundly influenced by real-world uncertainties, central bank decisions, and many other intricacies between the real economy and the stock market. Even if the end result may differ from their participants, the stock market is deeply intertwined with the pulse of the world, and real-world uncertainties can significantly alter and affect its delicate balance. Events like elections and geopolitical tensions can often trigger fluctuations, leaving investors and citizens around the world alike on the edge of their seats. The mere speculation of a change in political leadership or a brewing conflict can cause stocks to sway, let alone when those speculations turn into the grim, dark reality. If the recent events have shown us anything from an economic perspective, it's quite obvious that the market participants will show less reassurance in the state of the local economy and the stability of our societies. Additionally, we must face the fact that the looming risks of a recession may cast a shadow on the market. When economic indicators hint at a potential downturn, investors may become jittery, leading to heightened volatility. It is crucial to understand that the stock market isn't solely driven by the cold, hard numbers, but also human emotions and perceptions that play a significant role in shaping the market dynamics. We can actually argue that our collective and subjective perception of the future is more important than the objective facts, and that our personal impression from the immediate surrounding can affect our perception of events that happen very far away. And within these immediate surroundings is the central bank, a key player in the financial orchestra. The interest rates set by the central banks have a profound impact on the stock market's rhythm, especially for exchanges like Nasdaq, where the tech companies often dance to a different tone. When the interest rates rise, the borrowing becomes more expensive, affecting the profitability of those companies. For the more speculative tech companies that often operate on the thinner profit margins, or in fact, negative profit margins, higher interest rates can be particularly challenging. Investors may reevaluate the risk associated with those companies, leading to sell-offs and increased market volatility. Conversely, the lower interest rates can create an environment conducive to borrowing and investing, potentially boosting the stock prices. One perplexing aspect of the stock market is its ability to march to its own beat, seemingly detached from the real economy. While the economic indicators may point to a struggling or booming economy, the stock market may tell a very different story. This divergence becomes particularly apparent during periods when the real economy is faltering, yet the stock prices continue to rise. This phenomenon can be attributed to a variety of factors. Central banks' interventions, government stimulus packages, and investors' expectations can all contribute to this disconnection. It's essential for investors to recognize the fact that the stock market is not a perfect reflection of the real economy. It is rather a complex system influenced by a multitude of variables. When managing all these complexities, investors are wise to exercise vigilance and to broaden their perspective. Looking beyond the fundamentals of individual stocks, it becomes crucial to consider the macroeconomic and monetary landscape. Understanding how global events, central bank policies, and economic indicators interact can provide a more comprehensive view of the investment landscape. Macroeconomic factors like the inflation rates, the employment numbers, and trade balances should be on the investor's radar as well. Likewise, when keeping an eye on the central bank communications and policy decisions, they can offer insights into the direction of the interest rates and the overall market sentiment. Above these elements, that are all individually important to consider, there is also another one, the idea or the concept of cyclic movement. It is one thing to assume that things will always come and go, the good like the bad, but it's quite another to assume that the next cycle will look exactly like this one. The current market may be towards the end of a super cycle that began with the collapse of the 2008 real estate market and the quantitative easing that followed. A massive amount of capital has been injected in the market for more than a decade, and this has played a significant part in the recovery and later the takeoff of the asset prices. These policies may not come back, and there may not be the same kind of recovery that we have enjoyed after the last market collapse. The past doesn't guarantee the future, and it is no different this time. So really, the stock market is a dynamic and intricate ecosystem influenced by an array of factors. Real-world uncertainties, central bank decisions, often arcane relationships between the market and the real economy all make up what we see on the stock market. In this ever-changing landscape, investors should be well served by adopting a holistic approach that considers both fundamental analysis and macroeconomic perspectives. By staying vigilant and embracing a multifaceted view, investors can navigate the stock market with a far better understanding of the forces at play. Overall, my recommendation for Vym is to consider it as like an investment position that plays a stabilizing role in your portfolio to parry any volatilities that may negatively affect your other positions. The timing may not be the best at the moment to commit the vast majority of your capital, but a slow build-up over a certain number of months or years could be the way to go. Now, I would recommend to put around 5 to 8% of your portfolio's capital into Vym and to split the allocation in batches of 10 to 20% at a time.